You're listening to the Build to Rent podcast. Build to Rent podcast.
Welcome to the Build to Rent show, everybody. Steve Olson here with Sherrod Azanger and Chase Levitt for the much anticipated season 2 debut of the Build to Rent show. You've had this giant void in your life, and it's going to gradually fade off into the distance today as you hear our semi-planned and semi-unplanned commentary on what's been happening in the Build to Rent universe. And wow, when did we call it a wrap on season 1? That was like early in this year?
Yeah, I think so. First of the year. I don't know if we've done one for a while, so.
First of the year-ish. Sharon is checking her phone. She keeps us on track, or she got a super interesting text. One of the two things.
No,
She's checking out.
I'm showing February 3rd. So.
February 3rd. Just a little bit has happened in the Build to Rent universe since February 3rd, right? So we wanted to just kind of go over what's been going on since then, because you missed us so badly. I think we had 2 people ask when we were going to start recording again.
Oh, come on. It's been a little more than that. Okay, maybe like a half a dozen.
Yeah, right. But to our loyal listeners, we appreciate you, and you can always learn more about the show at b2rshow.com. And if you want to send a question, a comment, criticism, hate mail to Chase, you just go to b2rshow.com and click contact, and you can fill that out there, and we may even read it.
Or if you have any thoughts on what you want us to talk about, what's on your mind, send it over.
Or people that you may want us to try to get on the show. I know we talked about last season that we wanted to try to get a few guests, and I think we need to pull that off this season.
I think that's a good idea. Yeah. So if you'd like to come on the show, give it your best shot, fill out the contact form and tell us why. And it needs to be something that adds value, not just hey, I want to get on there and schlep my insurance or whatever.
Or if you want us to have somebody else on the show, like you want to recommend, and maybe it's someone we can reach out to.
Yeah.
We do have connections, not that many, but we do have connections.
We have some. Yeah, we do. We do.
Pull some strings.
So in February, we were in the heat of build to rent, real estate mania. Probably, would you agree, at the top of the U.S. real estate market in history?
Mm-hmm. Yeah.
Fair statement?
February, March for a little bit longer, maybe April, right in there.
Yeah, I remember talking about we couldn't get land, cities were out of their mind, you couldn't get labor. I mean, the only good thing going at that point was if you had property, you could get a good interest rate.
Yeah.
I mean, and that was great. In retrospect, you should have gotten property and gotten a good interest rate, because, wow, since then, what's been going on? What have you guys been seeing? What's on your mind since then? I mean, I know we talk a lot, but the listeners don't get to hear us talk. So
let's talk about the springtime just a little bit more. What happened? Rates were, like you said, were reasonable or a lot lower than what they are now. We were seeing multiple offers, whether it was our new construction stuff or stuff that we're trying to resell for multifamily.
Yeah.
And not just our product, right? Regular residential homes, bidding wars left and right. Things were crazy. People could not find a home. So you had a ton of buyers out there, not enough sellers. What else?
Historically low cap rates, institutions buying build to rent projects at low cap rates and making it work by assuming that rents were going to just go to infinity and beyond. Chase is going to Disney tomorrow, so that's your Buzz Lightyear reference.
There you go.
And that's how you could make it. Because I remember underwriting pro formas and doing financial models, just going, "This is stupid."
Well, we kept saying, "Who's going to buy this?" Okay, maybe if commercial institutions can pick something up like this, but really, like, is our investor going to purchase this? And some of them were. I mean, that's what was crazy, is that
and the biggest
they were
reason
getting away with it.
The biggest reason I think now, what we've learned, is cash flow. Were they still cash flowing?
Yeah.
Not by a ton, but with where the rates were and the prices went up, rates were so low that, and if the rents made sense still, right, we were still seeing cash flow positive in the springtime.
Yeah.
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 Or a break even.
And
But at least they got the property and they got a low interest rate. Right now,
Yeah.
Once again, the compared to what, right?
Yes.
It's slightly offensive, but we use the prettiest girl at the ugly dance analogy, right? It was still better.
Yeah.
Right? Especially if you had tax consequences you were considering. And we've done some episodes on that. But I talked to a broker here that is one of the top multifamily brokers in our home market in Utah. And yeah, people were just assuming that these rents were going to continue increasing, and they would put the assumption of a 10, 15, even 20% rental increase in their financial models. And that's what told them what they wanted to hear to justify the decision to move forward and buy that apartment complex. Right. And yeah, I mean, you know how sensitive that is. Chase, you alluded to cash flow. So many people are going back to that fundamental right now. And you know, you can say, did we ever leave it? I mean, a lot of people know I was always about it. Everybody was a little bit on fumes in February. But if you take that financial model and you're assuming like a 5 or a 10-year hold, and you are entering at a cap rate and then exiting at a lower cap rate, I mean, that internal rate of return is astronomical. Mm-hmm. And that's what was getting people to do that. It's easy when you say my rents are going to go up 10, 15, 20% to say, yeah, I bought at a 5 and I'm getting out at a 3.75 and here's my 32% IRR. And guess what? A lot of people were getting that. I think a lot of people that got that, though, didn't go in assuming they were going to get it. They were right place, right time.
Exactly, 100%. Because and then people started to catch on to that and think that they could do it. I know there was a project that we had spoken about in Draper that was their whole model, right? It'd be interesting to see where they're at now because that one's still under construction. So they wanted to get that completed and somewhat stabilized and then try to flip that. So it'll be interesting to see how that plays out for them.
Well, let's just not assume everybody knows why that would be interesting. Why do you say that?
Because I think that people thought they were going to make a lot more money. And now I think people are going to have to sit back on their heels and maybe not get as much of a return on an investment, right? And I think maybe somebody's they're going to have to hold on to that a little bit longer than they expected from the beginning. So, I mean, it may have put a lot of people in a pinch. I mean, the person I'm specifically talking about, we've all met with this person. He was a land contact for us. So it'll just be interesting because I think a lot of people got really greedy when they could pick up some dirt. And internally, this is probably the truth for us as well, right? And now people are sitting on dirt that's maybe not worth what it was, or they're midway through a construction, and now how are they going to get long-term financing on some of this stuff?
One thing that
What's that return going to look like?
Yeah, one thing that I'm curious on that I feel like we've done a pretty good job on with our projects and our pro formas, we've tried to stay conservative or pretty true to where the rents are. And so as we've seen with our projects, as our projects get built over a 1 to 1.5, 2 year period, in the past, those rents were going up, right?
Yeah.
$100, $200, $300 per unit. And I'm curious to see how many investors going back to the February, springtime, where things were so competitive, rates were good, what they were writing in their underwriting or their pro formas for their rents. Were they still being conservative, or were they starting to cheat a little bit and hope that rents were going to continue to trend up? Not to say that they can't or they won't. I just know, fast forward to today, that's a hot topic as well. Is we'll talk about rents a little bit more. Are rents trending down? Are they starting to level off a little bit? All I know is what I've seen now is rates have gone up. We'll talk about that more. And then people are a lot more sensitive to rents and where they're going in specific markets.
Speaking about cheating, though, remember there was a builder that you had shown us a pro forma on or had mentioned something about where they were putting depreciation back into their model to make their model look, or their pro forma look like it was cash flow positive or a good investment. I mean, I think that it's interesting how people, again, cheated the system and continue to even cheat the system. And that was obviously when the market shifted and changed. Because I think, like Chase said, we haven't increased our rents. Like the rents that we're showing on pro formas are current market rents. Or the interest rate's the one that's just a kick in the teeth, right? Because every day that's changing. Every week that's changing. We don't know what to put that at. But the rents is,
There's different ways you can cheat or fudge or stretch the pro forma. So it's really good when you're buying a property, understand that pro forma inside and out, understand what the rents are, not just what it says on it, confirm it yourself. understand what the expenses are, confirm those yourself, and make sure you feel comfortable before moving forward.
Yeah.
Well, and I don't think it's so much that builder cheated. I mean, because they did disclose in the fine print what was there. It's just, you're trying to put lipstick on this thing that was priced at 2020, 2021 pricing, right? When you're trying to sell it in the atmosphere of 2022 in a very different reality. So it's like you add in that depreciation, but can that investor take that right now? How much can they really take?
Yeah, how do they know how much that investor can take? It's a gray area. So
you don't know.
Cheat's probably a strong word, but
stretch is good.
Yeah.
It's in the investor has to understand.
There's a lot of stretching going on.
And it was frustrating on our end because I felt like, hey, we have inventory or we have stuff we're trying to sell, but we didn't want to do that same model, right? We wanted to do the model that we've always done and keep our pro forma where it's at.
Well, I remember on that pro forma we're talking about too, it was an interest-only loan.
Yeah.
Right? So you're only paying interest. So, I mean, look, they disclose it, and that's great. But investors out there, make sure that you understand what you're looking at.
Read
Don't
the
just
fine
look
print.
at that return. You got to dig into it, especially on these rents and these interest rates right now. Because I remember we had I got really, really into this. You guys probably thought I was psycho for a while, but we were vetting out a property in Texas. And this is still happening, by the way, right now, where a couple of these deals we're working on together, I feel like the price per door is a pretty good price. I mean, it's much lower than what you can get on the open market right now, but that interest rate just hammers it to death. And so I remember we were pitching this. It was a build for rent project in Texas, and I don't think we were going to have completed units till like summer of 24. And I want to know, air it out. That's what the show's for. My premise was, okay, we're looking at the rental market right now, and I think it was $1,900 is a number that we felt good about per door based on the product and the location. But this thing wasn't going to be for rent until 18 months from now. And so we kind of have this interest rate hung around our neck, but if the interest rate was going to be that persistently high until that time, I felt like we're going to have better rents then.
Well, 100%, because if your rate's higher, then your tenant pool is bigger because they can't afford to go purchase a home on their own. I mean, this rate doesn't just affect multifamily, right? It's affecting single family. So throwing a lot more tenants into the pool, which then again, supply and demand. There's going to be more tenants, probably less inventory because builders have slowed down, especially right now.
Yeah.
So less inventory to come 2024. Yeah, you couldn't help but say rents would increase, but by what? And I think that's the part that it's like we all wish we had the crystal ball.
And just a quick refresher, we've talked about this before. When you talk about interest rates hammering it, what's it hammering? It's hammering cash flow, right?
Yeah.
Interest rates, do they affect NOI or cap rate? No. It comes in after that. So when you say hammer, it's the cash flow.
Yeah.
So
well, and
that's
do people buy just on
at.
cap rate? And I think the answer we've received is some do, some are exclusively about cash flow.
Yeah. Some
and
are
it's
both.
funny because I feel like it before it was more people were buying off of cap rate. Like in the past, that was the majority of my conversations were cap rate driven, not really as much cash flow because the rate was so low that wasn't even a question. Like people weren't worried about what the cash flow was because it was cash flowing. But
well,
I think,
is there anything else? Am I missing something that the interest rate's going to affect besides cash flow?
Well, could it affect value?
Yeah, I was going to say the purchase price, right? Because you've got to drive that price down.
Eventually, yeah.
I read some articles. I love real estate Twitter. It's my favorite thing lately. And a lot of people talk about we're in a crappy phase right now called price discovery phase, right? The bid-ask spread is a fancy way for saying buyers and sellers are not agreeing, and the lack of transactions definitely shows that. But then you go, okay, buyers are holding back. I think more of the Main Street retail buyer is, I'm not so sure that institutional buyers are holding back a lot. I mean, I read about Invitation Homes just raised a boatload of money to go buy rental properties because they think there's going to be people distressed and selling at somewhat of a discount. So, and are things selling less? I just took an offer on a fourplex in Idaho, poster child for overhyped markets, right? And we came off 15% or so on our original list, maybe a little more, that got the deal done for a 1031 buyer.
See, and I think that's what it is. It depends on who is that buyer. And right now, obviously, we're coming to the end of the year, and so people are looking to purchase things because they want some kind of a write-off if they're in that position. So sometimes it's not necessarily about cash flow because they don't want a tax consequence. But I think the majority of the time it's about what the cash flow is right now. Let's
talk about price a little bit because I think the sellers are a little bit mixed up. And you talk about price discovery phase or mode. I think that's great. So in the springtime, we're wouldn't you say we're still in the price discovery phase as well, where
going up.
Yeah. Going up, we're like, okay, let's list it at 1.3, 1.4. And I think that's kind of where
add 10% on the highest comp and you might get it.
Yeah. And so that's where we were at that point. And so I feel like things were so crazy then, we were probably 5 to 10%, maybe above where comps are where it should have been, because everyone had FOMO or someone just wanted that investment property. They need to place their money somewhere. And now we're going back down. So you had to stretch up in the springtime. This is where it probably should have been. That was more like normal or realistic. Now we're going back here where this is where sellers think it is still, but it probably needs to be here. So it'll be interesting to see where those prices start to land, because I think a lot of sellers haven't realized where it's at, or they're just okay with keeping their property.
Mm-hmm. And renting it out. Fixed rate debt.
Yeah. I think a lot of our people that's where they're sitting, right? Yeah. A lot of them are saying, I don't have to sell. I'm going to sell if it makes sense to sell, but I'm not desperate to sell because it's cash flowing and my interest rate's a killer rate.
So
the truth is they can't trade it. They can't trade that rate.
Where are the have-to sellers going to take the market? I think that's the question.
Yeah.
The ones that have got to get out for whatever reason, what are they going to take?
I don't know. I mean,
price discovery phase. Yeah. Gosh, I hate it.
And it's a kick in the teeth. I mean, I'm running a pro forma on a duplex up in Idaho, and it's a little bit of a kick in the teeth trying to figure out where we want to be.
Well, mathematically, I've heard people refer to it as like, well, for me to get the same payment, then your price has to come here. That number is not acceptable to the seller. You're telling a seller that you had to come off like 30%. Will they ultimately be forced to accept it? We have to see. Something I've been thinking about, though, this rate went up so high, so fast. It like stunned the market. It's like you took a taser to the market and just shocked it. And people are just like, I don't know what to do.
Well, that's how I kind of feel. I feel like every day, is there going to be more bad news, or what are we going to do? Is this going to level off at some point? It reminds me of when COVID hit.
Yeah.
Right? It was like all of a sudden everything just stopped for a minute and people were trying to figure it out. And I feel like that's how we've been for the past couple months. Everyone's just kind of on pins and needles. A few things are working here and there, but where are we going to land? What's this going to look like?
Well, our buddy Lane Aldrich he's a lender. And he always shares this thought that the Fed needs blood. They need to show that inflation has backed off. And, you're going to see that too. There's drive around here, Arizona, Utah, where we work in the West, which was more overheated than some other markets, right? I haven't been having some of this problem we've been talking about in Houston, by the way. It's not been nearly as pronounced. I'm 1031ing it's a verb, 1031ing out of a property in Indiana right now. No problem, right? Things are tame, because those markets didn't skyrocket as crazily as the West. But you got to wonder if sometime early in 2023, builders are finishing out a lot of inventory right now. Is that inventory going to start coming to the market? We get that bump in supply that everybody has said, the market's not going to go down. There's no supply. Well, will that change? And I think we've seen numbers. There could be a good amount of supply. And when you combine that with the interest rates and where these people are, does that show the Fed what they need to start bringing rates down? Because Chase, you were doing the hand thing, right?
Mm-hmm. Yeah.
The people listening, Chase was doing this super high-tech thing with his hands. Showing the market is up
here.
Which
they probably can't see.
Yeah, and now it needs to be down there. But the market is up here. Buyers are there. This has got to be, I think, to me, prices and rates coming together. The rates this high, this long, and they probably have a little higher to go. I think the market is showing, that's no thanks. And then the prices, they can't just hang where they are. Eventually sellers have to sell. That's my theory.
Yeah.
First half 2023, price discovery phase is over, or we have a lot more certainty. Take it to the bank. It was said here first. Actually, no, I heard a lot of other people say it already.
And if you're wrong, it was said by Steve Olson first.
That's right.
Yeah,
That's right.
I think rates have to move at some point, but it probably won't be until late spring, early summer of next year until we see something maybe start to tick down. But they both got to go. You can't just lower price and keep rates where they're at, right? Like the rates got to drop too, because we need a little of that appreciation to come back too.
Yeah.
And one thing we've talked about, can we continue to see rates go up and see rents come down? Does that make sense? We've talked about that. If rates continue to stay where they're at or they go up, most likely we would anticipate that rents are going to stay pretty strong, possibly go up. That's just a thought we've had.
Yeah.
I'll date myself here, but when I was 13 years old, against my mom's wishes, I sneaked out of the house with my buddy and we went and saw a movie called Jurassic Park, which blew my mind. And there's a scene where Jeff Goldblum is kind of hitting on the blonde botanist. I can't remember what her name is. And he said, nature finds a way. And he says it all Jeff Goldblum-y, right? And the market finds a way. I talked to my dad a couple weeks ago. When they bought their first house, my parents, it was like 1985. I was like, how did you do that? Because I hear all this Jimmy Carter, Ronald Reagan rates were 7 million % talk. Mm-hmm. And I was a kid. I had a Superman cape. When that was going on, I was oblivious to it. And he said, oh, well, we got an assumable loan. And that was a big deal then. You'd come in with a down payment, but you'd assumed somebody else's loan, which was quite popular in the FHA space. And I think you can still assume FHA loans. The market finds a way. And right now it's finding its way because buyers and sellers do not agree.
Yep.
So what are you guys doing? Are you buying properties right now?
I bought one.
What's an update we can give the listeners?
Yeah.
New construction, yes. But that's only because our stuff is, again, wholesale. And that's what makes sense, right?
Because it's a little freaky if that wholesale spread isn't big enough. It's what do you actually have when it's done?
So I think it's a win-win is what I tell investors. If you want to sit on the sideline, kind of see where things go, it's not a bad idea. But also I think it's a good idea to always be looking, always be aware. There still could be opportunities out there, especially right now. So maybe don't sit on the sideline too long, but if you are, be looking for opportunities. I know I asked you guys that question. We're buying properties. Mm-hmm.
Yeah. And well, I'm closing on a duplex and a fourplex in Arizona in a couple of weeks on a 1031. I think the question to ask yourself is, if you buy a property over the next 6 months, are you going to be sad that you did it in 5 years? Probably not. There's people that probably think, oh yes, definitely. But probably not, especially if you take the whole pie into account of that time value of. I mean, what else were you doing with your money?
Yeah.
Yeah.
Bitcoin's pretty low.
If you look back historically, it's still climbing. So 5 years from now, I'm not going to look back and regret it, I don't think. Because, again, I have an asset, right?
Yeah.
And it's a tangible asset. And I think that's what's different to me. I do have money in the stock market, and I think that's great, and that's more of a long-term play, and so are a lot of the investments that I'm doing as far as property-wise. But I also have something that's tangible. So push comes to shove, I have something that I can sell, or I have something that I can move into, or I think I have options.
Yeah.
Well, to close it out, the market finds a way. The market also overreacts. We've all seen that. And the well-respected John Burns from Burns Real Estate Consulting, I saw a post from him the other day that I found quite interesting, and I think I know what to do with it, but I want to share it. This interest rate spike has been so crazy, and we see builders feverishly trying to finish what they had in the pipeline, but very little is going into the pipeline now. New permits are at really, really low rates. So I can't help but think what happens on the other end of, do you want to call it a glut? Do you want to call it a temporary increase in supply? I don't think it's an 2008 tsunami of supply. Very, very few people do. But what happens on the other end of that?
Yeah, come 2024, 2025, we're not going to have enough supply.
Yeah. It's interesting to look at the dynamics of the markets you want to invest in, unemployment rates, population growth. I mean, do you have reason to believe there's still going to be attractive states and metros to live in? And if permits are at a standstill, Chase, you said it the other day, do we want to be greedy when others are fearful?
I've heard that before.
Some guy said that once.
Yeah.
Worth thinking about.
Yeah.
That's a great comeback episode for season 2.
Yeah, there you go.
You know, like when you'd start a new season of 24, that first season or episode of the season was always like, oh, I got to watch the whole rest of it. I think we're basically the 24 of Build to Rent podcasts.
It's just us being raw. We're being open. We're being honest. So
I was being a little sarcastic, but yeah. All right, everybody. Thanks for joining. We'll catch you next episode on the Build to Rent Show.
Thanks for listening to the Build to Rent podcast. You are now just a few clicks away from joining our community of Build to Rent investors. All you have to do is follow our show on Facebook, LinkedIn, or wherever you're listening to this podcast. You can also watch this episode and more by subscribing to the Build to Rent podcast on YouTube. The information presented in this podcast is general in nature. Nothing in this presentation should be construed as financial advice or recommendations for any particular situation. The hosts are only licensed to provide advice and services in the states where they are specifically licensed, and listeners should seek the advice from an appropriately licensed professional in the area where they invest. The examples presented in this presentation are for illustration only, and no guarantee that similar results can be achieved, since the facts, circumstances, and participants are all different.